So not only did silver and gold break out versus the S&P, but silver has broken out of a decade-wide basing range versus gold. It's saying, I'm coming out of here. I'm going to beat you, gold. You've got, like a $50 range there almost. Well, add 50 to 50, the breakout point, you got 100. So even on an arithmetic scale, silver should just go to 100 just to match the simple arithmetic scale. What we do here is we divide silver ounce into an ounce of gold, express it as a percent. This shows 50 years. Well, you get that red horizontal line is at 2%. And you can see that in 20 years, in the past 50 years, silver's at least been 2% or higher. Well, right now it's 1.6. And we just broke out over the last 10 years of highs, that little green line, which we showed closer up on the chart above. He just broke out. If you even just go to 2%, I mean, that's a huge move from 1.6 to 2 on a ratio basis of silver versus gold. But we're in a bull market. And when you go back and look at the bull markets in net price of silver and where the spread was then, look at that 79 peak when it was gushing to the upside to the early 1980 high in price. The spread was at 6.5%. And then go to the 2011 high when again silver rushed up to 50 within the old price range. The spread was over 3%. Well, right now at 1.6, just to get to the spread level that we saw in 2011, you got to like double silver's performance level that it currently exists at. So each of these charts are telling us that the monetary metals and their miners have only just shifted trend versus the US stock market. It's a fresh buy signal telling you if you're going to reallocate now, you're not late. 50 years of silver. Unlike gold, which the 1980 surge was a tenfold move from the bottom of that range to the top, much of it compressed in the last 2 quarters of that bull move. Then it came all the way back down to the bottom of range and duplicated the same thing again in 2011, but it wasn't a new high. Gold was making a much higher high than it made in 1980 when it got to its high in 2011. And yet silver, while it had a big move from the bottom of that 50-year range to the top, it was just duplicating the same price that it was in 1980, 30 years later. So, how come? It moves with gold. It goes up and down with gold. No issue about that. But why couldn't it go up above the high of 1980 like the same dimensions the gold did? Okay, now we've broken out finally. Okay. And on this log scale chart, if you did what gold has done twice before, now maybe is doing a third time, if you took the prior move in silver on a ratio scale and added it to the point of, we could be $500. A tenfold move getting above 50 means you could go to 500. But if that market starts to accelerate on the downside, the dollar decline, and the T-bonds start to break their supports, those are headlines the public doesn't want to hear or see because these markets are huge. They dwarf the stock market, especially the T-bond market. So that's something I'd be watching as a factor that not only damages the stock market, but panics the central banks, not just ours, into full print mode. Meaning what? Gold and silver benefit.
Michael Oliver's technical analysis reveals a major market shift happening right now. The U.S. stock market is showing classic topping patterns identical to the 2000 dot-com crash and 2007 housing crisis, with a potential significant decline expected in 2026. Meanwhile, something huge just happened. Gold and silver broke out of massive decade-long basing patterns versus the S&P in November-December 2024, signaling fresh capital rotation into monetary metals.
And I know a lot of people make the mistake based on a few historical misexamples that, if the stock market goes down big, gold and silver go down too. It's totally untrue. Yes, there have been points in the past where you could find a hugely bad month in the stock market. It's already been going down maybe for a year. And then suddenly gold and silver have a break as well. And then people are like, see, but really the major trends don't correlate well. So anyway, so I see a total opposite picture in the monetary metals, silver versus S&P. Also in November, it broke out over a similar basing pattern and relative performance to the stock market. That arrow shows where it was in November. Look at the December close, whoosh, even further. So silver has also said, I'm out of here, freshly so, versus the US stock market. This is not a late signal. This is an early signal. Each month, we take the close of gold and divide it into the S&P price and express it as a percent, and we plot it. Okay, so these are monthly closes going back to 2013. It's when gold was really collapsing back then. Also in relative performance, it was coming down. But since about 2015, you see the price action, the spread action has basically been either side of 50%, been above it and below it, above it and below it, but sort of really going sort of sideways. So gold's been hanging in there versus the S&P, been doing as well. November's close broke out above that 4-point, very gradual downtrend line that capped off this relative performance chart for 11 years. It broke it out in November. A huge wide base. This is the start of something, not the end of a bull market. This is telling you that the money flow into gold, while it's been very strong over the last few years, was still within the range. And it's only in November that it finally broke out, in December even more so, and said, I'm out of here. What it's telling you is money is starting to shift from the stock market to the gold market. It's actually been going on since 2024 when you were near the bottom of that range, but now it's broken out. So this is effectively a fresh buy signal telling you if you're an investor, should you be in gold or the stock market? It says, yeah, you should be in gold. It's just begun.
Silver is the real opportunity here. Currently trading at only 1.6% of gold's price compared to historical bull market peaks of 3 to 6.5%, suggesting potential upside.
Summer of 1979, in the next 5 months, almost 2 quarters, silver quadrupled in price. Not just beating gold, but quadrupled in net price in 5 months up to the 1980 January high. A similar pattern occurred in September of 2010. Silver had already been in a bull trend, so had gold. But at that point, silver suddenly broke out versus gold. And in the next 7 months, so about 2 quarters, it doubled and a half in price. Okay, this just broke out. So we set our clocks here and say, listen, we've learned in the past, and there's other examples of this, where when you do this kind of breakout, give it a couple quarters and you should see a gush in net price. Now, maybe it goes further, but the gush part, the extreme change, occurs literally in the next couple quarters. The gold miners versus gold, I don't have the chart here, are very near a massive 11-year wide base, relative performance base, versus gold. XAU index divided into an ounce of gold collapsed in 2008 through 2015. And that spread got all the way down to 4%, where the price of XAU was only 4% the price of gold. Heck, if you go back to the 1980s, 1990s, up through about 2008, if you divided XAU index into the price of gold, it was like on average 20, 25% of the price of gold. Right now, we're about 8%. So we're still dirt cheap, vastly undervalued to silver. Silver miners are, and the silver miners are vastly undervalued to the gold miners. So when this catch-up occurs, this repricing, this new reality, that's the category within monetary metals that is the most depressed, hence the most likely to resurrect in a violent way. Right now, I'm entirely focused on monetary metals, but you're correct. We measure the Bloomberg Commodity Index, which is a well-weighted, balanced index of commodity prices. And there's some sectors in there that are strong right now and some that are still very anemic, like the oil sector is anemic, very weak. But I think oil is about to snap back to the upside, by the way. Technically speaking, I can see the argument. It's very close to upside breakout levels. Don't see it on price, but on our momentum, we do. So even that weak component looks right for a fairly violent upturn. But overall, the Bloomberg Commodity Index is still one dirt cheap historically. It's like now at 110. Like I said, 2008, it was 237. Okay. So we're not even half the price we were then, whereas gold's above that price, right? Okay. The commodity sector, when you measure it versus the S&P also, is dirt cheap, but it's basing, meaning it got dirt cheap a couple years ago and hasn't gotten cheaper. And we're just starting to flatten out. So it's not loss value versus the S&P. It's still just very depressed. Everybody's focused on the stock market and internals, like what's Nvidia doing? What's this stock doing? They need to be watching closely the T-bond market, long end 30-year T-bond futures, for example, the long end of the government debt market, which is very sick. Okay. It crashed in price, rose in yields. From 2020 to 2022 low, the T-bond futures dropped from 190 down to 117. And we measure that it's tried three separate times, and usually three times is all you get. And if the third time doesn't work, watch out. Right now, T-bonds are trading around 115 futures, T-bond futures. You drop down around 111, and we'll specify the numbers clearly to our subscribers because they do shift. And you could expect that market to start to puke again, meaning yields break out to a new high. This end of the market is not controlled by the Fed very well. They control that short end, but they don't control the long end. And Williams, who's the president of New York Fed, a month ago, or a little longer than that, made a speech and said the Fed is now going to buy, quote, buy bonds. And he said the reason for that was not that they needed to support the government bond market, that would be a panic statement, but because of, quote, illiquidity in that market. Oh, great. Okay, no problem, right? Well, they've been buying for the last couple of months, and if you look at T-bonds, they're not going up at all. All they're keeping is it from collapsing. If you're afraid that one, the stock market's going to enter a bear market, therefore, why should I buy anything in the stock market? Those sectors don't move in sync with the stock market. There's plenty of times when the stock market's been strong and they're anemic. So they do the opposite sometimes. So I would look at that as a probably something when it's already, I think it's already begun, by the way, this shift. Not so much the price chart breakage in NASDAQ, but just the spread between it and the S&P. That's when the market started to cave. It's been late 2000. We're starting to see some of that now, where over the last couple of months, NASDAQ has been anemic compared to the S&P. And I know a lot of investors out there have said, oh, this is good rotation. The market's finding new leaders. The game doesn't work that way. When you rotate out of the leader in the latter phases, that's a bad sign. And yes, there will be things that do better than AI. And like, look at NVIDIA now compared to its high, compared to S&P compared to its high, or financial sectors high, closer to its high than NVIDIA is. Those are going to break. But as far as other places to be, I think the world's going to shift their attention and then their emotions more from the paper assets that they've been bubbled all about for the last couple of years, especially into things under their feet. In a way to put it crudely, grains on the dirt, metal under the ground, oil under the things that are real they can touch, and leave behind the things that are breaking. And I think it's going to be not only an investment shift, but I think there's going to be emotion attached to it as well, where people suddenly want to have something that, a bar of silver, makes you feel pretty good, especially if it, has doubled over the last 6 months or so, you get my point. I think those are the places I'd be, monetary metals, but also, though not the same bang for the buck, but basic commodities and stocks.